The United States commercial real estate market is facing the largest debt bubble we have ever seen, and most people are completely overlooking the impacts of this. I'll show you. This is a chart from the Federal Reserve Bank, and what you'll see is that between 2013 and today, the total amount of commercial real estate debt has more than doubled in the United States. But unlike buying a home where you can get a 30-year fixed-rate mortgage, most commercial real estate debt is an adjustable rate mortgage, meaning that your monthly payment will change depending on where interest rates are. And let me show you why that's important. During the real estate boom of 2020 to 2022, interest rates in America were at their lowest levels in recorded history ever, and you can thank the Federal Reserve Bank for cutting interest rates again and again and again for that. This means that there are three things happening. We have right around $3 trillion worth of total commercial real estate debt outstanding, which is the highest levels ever, which really by itself isn't that big of a deal, but you'll understand why this is important when you look at number 2 and number 3. But this $3 trillion of outstanding commercial real estate debt is just about double what we had during the peak of the 2008 real estate crash. The second thing you have to understand is that $1.5 trillion, or about $1.5 trillion worth of this $3 trillion worth of outstanding commercial real estate debt is set to readjust by the end of 2025, and the interest rate that these $1.5 trillion worth of loans is going to readjust at is still uncertain. But what we're seeing today is that interest rates have been growing at their fastest rates really ever, and now we're seeing interest rates much higher than they were not just in the last few years, but in the last couple of decades. But there's still one more piece to this that you want to understand. So to help you visualize this, let's assume that you went out and you bought this building for $10 million. It was generating, let's say, $500,000 of net income after paying for all of your expenses, but before your mortgage. So you bought this property, it's a 5% cash on cash return because you bought it for $10 million, it's generating $500,000 of profit. Now, assuming you didn't buy this property all cash, you put down $3 million as a down payment to 30%, so you finance the other $7 million at a 4% mortgage. Now, if you got a 4% mortgage on the $7 million rather, that means your mortgage payment would be $400,000 to the bank, which means you would be netting, after all expenses, $100,000 after paying the bank, which means you are cash flow positive. Now, typically what would happen if you would see your debt readjust is now you would go to the bank and say, I need to readjust my loan because now it's time for my loan to readjust. What are my options? And generally, commercial real estate have rent raises built into their leases. So now the goal would be that you readjust your loan, and even if your payments go up, you'd be okay because now you're generating more income here because your rents are rising. Or you can do option number 2, is you can just take the cash. Because generally, commercial real estate is valued based off of this number right here. How much money this building is generating, how much net income is this building generating. So if, assuming now this building could generate, let's just say $600,000 a year in net income before your mortgage, now this building might be worth $12 million. So now if your mortgage payments don't change, you're making more money every single year because your rent payments are going up. Or you can just take the cash. You could sell the building now for $12 million and walk away with a couple $1 million worth of profit because now you're making more money here. Or you can do a cash out refinance because there's more equity in the building. Or you can just continue making the higher payments, if there are higher payments to begin with, depending on where interest rates are. Or if interest rates fell, that means you're making more money every single year. But what we're seeing happen today is a little bit different. Let me start by removing the $600,000 net income figure because that was assuming best case scenario and rents were rising, because we're seeing something different happen right now. Let's assume that you bought this property for $10 million, the same situation here, and you have a little bit more equity in the property. So you still owe $6.5 million on your mortgage. And now it's getting close for you to readjust because, well, that time is coming. Now, mortgage rates are not where they were before. It is generally higher, the interest that you pay for a commercial building, than the home that you live in. So let's assume now that mortgage rates are at 8%. This means now that your monthly or annual payments are going to be a lot higher than what they were before. Before you're paying $400,000 a year. Now at 8% for the $6.5 million, you're going to be looking at paying right around $570,000 a year on your annual mortgage payments. Now again, you're making $500,000 a year in net income. This would mean that you're cash flow negative now because your mortgage payments are higher than what you're generating. Now, at this point, you would hope that rents are rising. That way now you would hopefully be making $600,000 a year in income. That way you're still cash flow positive, although not as much as before, but you're still making some money from the property. But what we're seeing, a new report from September 2023 says that actually office vacancies in the United States are still high and still rising around the country. That means maybe this $500,000 figure that you were generating was assuming that most of this building was full. But now maybe part of this is sitting vacant. So maybe you're not generating $500,000 a year. Maybe you're only generating $400,000 a year. Again, just hypothetical figures. But then the next question is, well, okay, you're making $400,000. Your mortgage payment could potentially go up to $570,000 a year. That could be a problem. Can't you just milk the rest of your tenants and ask them to cover the cost of these people that are not paying? Well, now, assuming that was actually the business savvy thing to do, if you look at the numbers, the data will tell you something different, because what you're seeing is that office rental prices are actually falling. The average United States office listing is down 2.2% year over year. That means not only are you not making money from these units because they're sitting vacant, but you're also making less money from these units because office rental prices are actually falling at a time where expenses are rising. Now you can start to see where this is a problem, because number one was you just raise the rents, right? What's the solution? Option number one is you raise the rents, and normally you have these rent increases baked into the leases, but now what you're seeing happen because of this changing landscape is that in many places office lease prices are actually falling, and if you're sitting vacant, that means you're generally making less money, which then leaves us with option number two, which is you can walk away with the cash. But the problem is, well, the valuation of these buildings are also falling, because remember what I said just a couple minutes ago. The valuation of these buildings depends on this number right here. How much money is this building actually making? So now, if this building is making $400,000 as opposed to $500,000, well, now you can start to see that maybe this building is not worth what it was before. In this situation, assuming that somebody would be willing to buy this for a 5% return, you take the $400,000 divided by 5%, or 0.05, and that would mean that this building is now worth $8 million. However, again, there's another little issue with this, because if somebody were to buy this property with a loan, with a mortgage, you're going to have a really tough time making the payments, because if you buy this building for $8 million and you get a loan for 8%, well, that means you're going to be losing money every single month. So now if somebody wanted to buy this building and get this 5% return, well, the only people that are actually going to make any cash flow are the people that can buy this property all cash and not get any loans, because, well, with these high interest rates, it doesn't really make sense to go out and finance this particular deal, because you're going to be cash flow negative, which means now maybe somebody will need a higher rate of return. Maybe somebody will need an 8% return to justify buying this property. So now, if you go out and buy this property with an 8% return, now you're not going to be willing to pay $8 million for this. Now the maximum that you'd be willing to pay is $5 million. And again, you take that $400,000 divided by 8%, and now you can see that maybe you're only going to be willing to pay $5 million to buy this property. But again, there's a problem with that. The problem here is this. You, the owner of the building, currently have a $6.5 million mortgage on the property. Somebody's willing to pay you $5 million. That means you're underwater on the value of the property, and you're underwater on the cash flow. This is the problem in the real estate, commercial real estate market right now, because if interest rates continue to stay high, and we have $1.5 trillion worth of commercial real estate debt that's set to readjust by the end of 2025, what's going to happen to all these loans? Now, not all of the $1.5 trillion worth of commercial real estate debt is office. Not all of that debt is underwater, but a chunk of it is. How much? Well, we're not really going to know for sure until that time comes. So when 2025 comes, if interest rates stay high, you can expect to see a big shakeup in the commercial real estate market, which means if somebody is an owner of an underwater building where they're losing money every single month, they could be in a lot of trouble. Now, what does this mean for you? Well, this could potentially create opportunities for investors because, well, while downturns are bad for certain people, they can also be good for other people, but this requires you to be financially educated and understand what's happening. And the second thing that this means is what's going to be the impact of this, assuming interest rates stay high into 2026. And by the way, the Federal Reserve Bank, just in their most recent meeting, says that they expect interest rates to stay high into 2026. So if interest rates continue to stay high through 2025 into 2026, how is this going to have an impact on the broader economy? Could this potentially lead to other issues in the banking sector or into other industries in the economy? Well, of course, only time will tell, but what we know is that our economic system is a big intertwined web. No industry lives in a vacuum. The commercial real estate market is not in a vacuum, because if people start to get hurt financially here, well, that means people are going to have less ability to spend in other places, which would impact other parts of the economy, which is where, again, this is where it's important for you to start building that financial education and understand what's happening. Now, before I go any deeper in that, I do want to let you know that my team at Briefs Media put together this amazing ebook called How to Build Wealth as an Investor. This ebook will walk you through things from the basics of how do you build a mindset of an investor, to how do you save your first couple $1,000s, to then how do you make your first investment, what are the different types of investments that you can make, how do you start generating cash flow, how do you spend your money smartly, how do you earn more money, and how do you protect your assets. This ebook is completely free. So if you want to read this ebook, I'll put the link to how you can download it down in the description below. That way you can start working on your financial education and learn on how you can start investing your money. So if you want to read this ebook, you got the link down in the description, where you can go to briefs.co/ebook. The thing that I want you to pay attention to here is, number one, how do you protect yourself? And number two, how do you capitalize on opportunities? If you have a business, well, this could potentially create opportunities for you to go out, get some office space at a discounted price. If you are a real estate investor, this could again create opportunities for you to potentially find some good deals in the market. Now, of course, we are seeing low inventory across multiple industries, from office to apartments, but if you start to see more economic pain as debt starts to readjust, you can start to see why that could force more people to want to liquidate or sell off some of their properties. However, again, if interest rates are very high, that's going to make it a tougher investment unless you can get a low enough price, where, again, people who have the ability, who have more cash, can have a little bit more leverage and a little bit more negotiating ability on how to make a deal work. So this is where, again, you want to start using this time to be more financially educated and to build a financial preparedness, meaning being smart with your money. How can you be in a position to be able to capitalize on opportunities? But in order for you to do that, you have to understand what's happening, pay attention to what the Federal Reserve Bank is doing, pay attention to interest rates, and then understand how you can capitalize on opportunities that might be coming your way. US News put out this article on what they call the 7 best dividend-paying ETFs that you can consider buying. Here are the 7 ETFs that they recommend, and again, investing has risks. Make sure you always do your own due diligence and never blindly follow a random guy on YouTube. Number 1, SCHD, which is paying out 3.6% a year in dividends.